For more than a decade, big tech has been the unstoppable force driving Wall Street. Companies like Apple, Microsoft, Amazon, Google, and Meta didn't just dominate headlines, they defined the market itself. Investors piled in, believing these giants were untouchable, powered by innovation, scale, and near-monopolistic control over the digital world. But in 2026, something subtle yet significant is happening behind the scenes. Wall Street isn't loudly abandoning big tech, but it is quietly shifting away, and the reasons might surprise you. To understand this shift, we need to start with expectations. For years, big tech thrived on explosive growth, double-digit revenue increases, massive user expansion, and constant innovation justified their enormous valuations. But today, that growth is slowing. These companies are no longer scrappy disruptors. They are mature giants. With maturity comes limits. It's simply harder to grow when you're already dominating global markets. Investors are beginning to realize that the era of hyper-growth may be coming to an end. Another key factor is regulation. Governments around the world are tightening their grip on tech giants, introducing new rules, antitrust actions, and data privacy laws. For Wall Street, this introduces uncertainty, and markets hate uncertainty. Even the most powerful companies become less attractive when their future is tied up in legal challenges. At the same time, interest rates have reshaped the investing landscape. As rates remain higher in 2026, money has a cost again, changing how investors think. Suddenly, profits today matter more than promises tomorrow. Investors are now looking towards sectors that can deliver strong returns in the present. Capital is flowing into industries that were once overlooked, like energy, manufacturing, healthcare, infrastructure, and finance, offering stability and predictable returns. There's also the rise of artificial intelligence to consider. While AI brings opportunity, it also demands massive investment, raising concerns about timelines for profitability. Another shift is diversification. Portfolios once heavily concentrated in a few tech stocks are now being spread across multiple sectors to reduce risk. Geopolitics is also playing a role, with global tensions, trade restrictions, and supply chain concerns pushing investors to rethink heavy exposure to tech. In the end, Wall Street's quiet shift away from big tech isn't about fear, it's about adaptation. The market is evolving, and this transition may define the next era of investing.